The LIFO reserve is the difference between the ending inventory under FIFO. Sometimes you'll see this as in the footnotes. Replacement or current cost. And this has to be disclosed. We said these are footnotes. So in the footnote, you'll find the LIFO reserve. I'm going to go to page 4, just to remind you where this comes from. And the LIFO reserve itself, as we said, is simply the difference between FIFO, current cost. This is module 10.2, page 4. So the LIFO reserve is simply the difference between the current cost and the inventory under FIFO and the LIFO cost. Now, this can be used, I'm going to show you this a little bit later, can be used to convert a LIFO company back to FIFO. And we said, why is this disclosure so easy to get? Well, you have to realize that the company is going to keep their records on what basis? On FIFO, right? I mean, your retail store or your store that sells products that are subject to style change, you're not going to sell the last ones in first. You're going to sell them in a first in, first out order. And therefore, you have the ability to manage your company under FIFO. Now, the change in the LIFO reserve, the LIFO effect, from 1 year to the next, is the income statement effect. So this is going to be the balance sheet. The LIFO reserve is the balance sheet effect. So when the LIFO reserve goes up, you're getting what you want out of LIFO. Higher prices and increasing inventory levels. So you're getting the higher cost of goods sold, the lower profit, and therefore the lower taxes. If the reserve goes down, it could be due to a LIFO liquidation. Quantities could be dropping or prices could be dropping, but the cost of goods sold declines. Now, the way this works can be illustrated on page 5. So let me give you a chance to at least take a look at that. So again, the LIFO reserve itself is the balance sheet effect, is the difference between the ending inventory, the change in the reserve from 1 year to the next. If it goes up, then you get higher cost of goods sold, lower profit under LIFO. If the reserve goes up, it means that prices are going up and quantities are either going up or being constant. If the reserve goes down, prices are dropping or quantities are declining. I'll show you how that works over the next couple of modules. Now, to prove this out to you, unless there's any other questions on this, so this is your income statement effect on the LIFO effect. So if you turn to page 5 of module 2, I'm going to go through a simple example with you that would show you that if you took the change in the reserve, it would allow you to convert profit, and it would also mean that the reserve itself would be able to convert balance sheet. So let's assume that what you have right now, you don't see, this is what's reported. So let me just shade this area. So what you see in the gray is what's reported. So on the balance sheet, you've got beginning inventory of 2,000, you purchased 45, goods available 47, ending inventory is 5, COGS is 42. You go to the balance sheet and you look at the LIFO reserve. The beginning LIFO reserve is 900. So if you were converting the balance sheet, you just have to add 900 back to LIFO to get to the FIFO basis. At the end of the year, the balance sheet under LIFO is 5,000. If you go to the footnote, you find the reserve of 13, and you get the ending inventory under FIFO. So it's that simple. It's the difference between the two. And that'll be given to you, so it'll be disclosed. I would tell you what the reserve is. But notice that, what's the difference in cost of goods sold? The LIFO cost of goods sold is higher than the FIFO by how much? By 400. And what is that? That's the increase in the reserve. So the reserve went from 9 to 13. The increase in the reserve will be the difference in profit. So the change in the reserve is the change in profit. That means you're getting what you want. You're getting higher prices, or quantities are not shrinking. Because remember, when quantities shrink, you get a LIFO liquidation, which I'll show you in the next module. Questions here? All right, so let's change the scenario. And the next case, you report the following. So the financial statements use LIFO. Beginning inventory is 2, purchase 45, goods available for sale 47, and ending inventory is 5,000. How do you convert the balance sheet? You add the reserve to the beginning inventory, it's 2,900. That's the FIFO beginning inventory, and then ending inventory, add the reserve again. But notice what happens in this case. The cost of goods sold under FIFO is actually higher. So I want you to just make sure you note that in this case, the LIFO cost of goods sold is lower than FIFO, which doesn't normally make any sense if prices are rising. But in this case, you could have declining prices, right? Because sometimes prices could decline. What happens if you're in an industry where prices are always rising, then all of a sudden there's an aberration, something happens, there's an oversupply, and therefore prices start to drop. Or quantities could shrink. And I'm going to show you this in just a minute. When quantities decline, what does it mean? It means that you're releasing old layers of inventory at lower cost, and cost of goods sold goes down. But notice the key here is that the difference is that the FIFO cost of goods sold is higher by $700. And that's exactly the decline in the reserve. So you can go to the footnotes, get the reserve, convert. And what I'm doing, and I said this from day one, what we all need to do is think about how this is going to be used. I mean, you can go ahead and memorize that you have to have a disclosure. Why is that disclosure there? That disclosure is there that enables someone so that that individual or those groups of individuals can convert. So the reserve and the change in the reserve will allow you to convert the inventory under LIFO to a FIFO basis, and the cost of goods sold as well. And in financial modeling, there are lots of uses. Remember, maybe for insurance, for collateral. One use that I know of that's very common is that in a merger or acquisition, initially, before the deal is a live deal, where you would actually spend the money to appraise assets and liabilities, what do you do? Well, you'd have to try use the best information you have to revalue the company. And as we know, FIFO is as close as possible to current cost or fair value. So if you wanted to know what the inventory was worth for a company that you're buying before you want to buy, before you go in there and actually have appraisers come in and count the inventory, the closest thing you can do to get the fair value is to use the LIFO reserve. So the LIFO reserve is used not only in insurance, let's say for collateral, but also in mergers and acquisitions. So the LIFO reserve is a common disclosure, which we're going to look at in module number 4, which we should get to today. And I'm going to show you an actual case where we've got live financial statements, and we'll apply that. All right, so now before we move on to the next module, any questions on the LIFO reserve and how you're going to use it? All right. Then, let us go to the next module, and I'll get to those questions, as I said, when we get to do a review. Module 3. In this case, we're going to talk about what we mean by the term LIFO liquidation. Generally, in order for LIFO to be tax beneficial, what do you need? You need to have prices rising, and you need to have quantities constant or increasing. If quantities drop, you're going to eat into those base layers and have the lower cost released. Lower cost lowers cost of goods sold and raises profit. The term LIFO liquidation applies to cases where older costs are used to value cost of goods sold. So let me give you 2 examples. Number 1, here is the no liquidation case. So in this case, there is no liquidation. So let's look at a standard LIFO type of question. So we know that company starts with 400 units at $1. They purchase on May 1, 300 units at $2. So they've got 700 units available at a cost of a total of 700. On June 30th, they sell 200 units, and I'm going to assume the selling price is 7. That doesn't show up in the cost table. So that will be something we'll deal with in a second. Then they buy another 100 units at 3. And then they sell 200 units, and again, we'll assume it's going to be at, I'm sorry, that's the same sale. So they purchased 100, and this is the total. So they have 100 units added, 800 available, they sold 2, so the ending inventory is 6, and the cost of goods available is 13. Now, without the liquidation, let's calculate the cost of goods sold. If this is LIFO, the last goods in are the first ones that they're going to sell. This is perpetual, so we have to look at this at the point of sale. So to make sure we see this. This has to be at the point of sale if it's perpetual. So at the point of sale, when you sold these 200 units, the last goods in are going to be the May 1st purchase. So let's make sure we understand that if you sell 200 units on June 30th, and it's LIFO, the 200 have to come out of that batch. So your cost of goods sold would be $2 times the 200 units you sold. So that's 400. I'm also using this to review. When we have the next sale was we had a purchase and another sale. So we'll go back and show you this again. So we had a purchase on September 30th at 3, and then we had another purchase of 3. And again, to get the ending inventory, that has to be included. So this sale has to come out of this batch. Now, when we calculate the ending inventory, it's going to be 400 units at $1. How many units are left here? 100, right? If you sold 2. So that's what we're looking at right here. So the ending inventory is going to be 400 remaining at a beginning inventory, the 100 that remain out of the sale, the batch that we sold, and then the new purchase at 3. So the ending inventory is going to be 600 units at a total cost of 9, and the cost of goods sold would be 4. So your goods available is 13, 400 is left, and 400 is sold, and 900 is left. So if we look at the first case with no liquidation, cost of goods sold is 400, and ending inventory is 9, and that's the total available, 13. And I'm doing this to make sure you keep in mind you always have to come up with the total available. Now, let's look at a case where there is a liquidation. This will be the liquidation case. Turn the page. Now, in this case, we're going to assume that the May 1st purchase is not sufficient to cover that sale. So what's going to happen? On June 30th, you sold 200 units, what's going to happen? You're going to sell the last ones in, so you're going to sell 50 at what? At 2. And the other 150 have to come out of where? The base layer. So you didn't buy enough to cover the purchase, so you have to liquidate those base layers. And therefore, you get the same result, except that in terms of sale, 200 units at 7. You also get the same purchase, another 100 at 3. What you don't have, however, is enough to cover the sale. So your ending inventory is 350. So in this case, notice what happens is that when we calculate the cost of goods sold, it's got to be 50 units at 2, 150 units at $1. So the cost of goods sold now becomes 250. The ending inventory is going to be the remaining units in the beginning inventory, which is going to be the 250. So in other words, let me go back, let me put this in so you know that the beginning inventory was originally going to be 400 units. It was. And out of that, you sold the 150. So the units that remain are 250 at $1. There's nothing left in the first purchase because you sold all those out. And then the September 30th purchase is 300. So the ending inventory is going to be 550. And the cost of goods sold is 250. Now, all you had available here was 800, so that's going to be a little different. So, let's go here, just to keep track. With the liquidation, the cost of goods sold is 250, and the ending inventory is going to be 550. And the total available is going to be 800. So the first and most important question for us is whether or not you see the liquidation. Okay, we want to make sure you see the liquidation. So by selling the units, let me go back to the screen I want to make sure we see that liquidation. So if you sell 200 units, the last one's in or the May 1st purchase. So this 200 is going to come out here and 150 at $1. So here's where the liquidation takes place. You sell off the 50 and then 150. And that's where the liquidation takes place, where you're eating into like the base layers of inventory. Doesn't mean you're selling new units, but that's the price you assign. Now, the danger, in a sense, for the liquidation is that it means that your cost of goods sold has to be higher. The cost of gross profit has to be higher because your cost of goods sold would be lower now that you're releasing these older units, older costs. All right, questions on that? I'm trying to go as slow as we can because this is a little tricky. Yeah. Cost of goods sold is lower now. It's lower. No, I'm saying that the gross profit would be higher. That's the problem. And the gross profit is higher, and that's why taxes go up. Yep. The beginning inventory is 400. Well, that's what's left. That's what's left. So when we go down here, and we're trying to determine the ending inventory, it's going to be 400 units that you started with minus the 150 you sold. These are layers of inventory. So what you have to do in LIFO, you have to keep track of where the units are sitting, and you keep layers. And the idea really is to build the layers as deep as possible so you don't liquidate them. So the beginning layer now has been breached in a sense. And that's the problem. You don't want that layer to go below 400, but it just did. And that's the liquidation.
The unit cost for inventory?
The unit cost, these are the unit costs, so these we didn't get.
No, for ending inventory.
The ending inventory itself, so you'd have to say the ending inventory is the oldest cost, the next oldest going down. So the oldest cost is $1, what you have left there, or $2.50. The next oldest cost would have been $2, but because of a perpetual, you've already sold those. So you've got nothing left there. And the entire purchase of September 30th remains. Now, if this was periodic, what would have happened? Your sales could have came out of here. And that's why periodic is unrealistic, because the sale was June 30th, and this is going to be a September 30th purchase.
What we're doing last period, what we're doing weighted average?
Well, that was an average, yeah, it's a separate, this is LIFO, yeah.
So for weighted average, how is the formula to calculate?
For weighted average in this example, yeah, for weighted average in this example, you would have had, the average would have started at $1, and then after this purchase, it would have been 500 divided by the 450, that would have been your average cost,
Okay.
and that would have been the cost of goods sold.
So my total cost of the units?
Yeah. Sure.
No, so just to clarify, anything that breaks through the purchases before the sale has to LIFO liquidation.
Well, older units, so it has to be generally from the prior year. It does count, yes, it does count here, but if you bought enough, so for example, if I would have purchased enough units here, if I would have purchased, 200 units here, I would have avoided releasing the older costs.
Under LIFO, would you want to have like a safety stock?
Yeah, see, that's the problem. That's the problem with LIFO. With LIFO, managers sometimes will, I want to say it's true, but the accusation is that managers will buy more inventory or produce more inventory to avoid the liquidation. But doing that means, the logistics problems. You got to store, insure them, handle the inventory, and then you run the risk of obsolescence if you overbuy. So management of inventory becomes tricky when you've got this tax problem, this liquidation problem. Now, you have a liquidation here, and I just mentioned this. This is the easiest way to figure this out. If you, at the point of sale, if you purchased or produced fewer units than you sold, you got the liquidation. And the liquidation is what, 150 units, right? There's the difference between these two. So you've liquidated the 150 units, so that we know. Now, here's the problem. Where are the liquidation profits here actually, as we said, come at the cost of goods sold difference. But when you look at the cost of goods sold, you're not going to see liquidation. So if you just looked at a set of financial statements, what are you going to see? You're going to see sales minus cost of goods sold. You're not going to see if there's a liquidation. Now, would that be a problem, do you think? So let's just think about someone using your financial statements, and you certify those statements. You put the statements together. Now there's a trend. And all of a sudden you see gross profit going up, cost of goods sold going down. What might you assume if you were looking at those statements? If cost of goods sold drops and profit goes up, what would be the normal assumption? What would you think?
You acquire material for a lower price?
Yeah, you're able to produce at a lower cost or maybe raise selling price. The problem is it could be due to liquidation. So we have to disclose liquidation profit. So for that reason, if it's material, we have to disclose the liquidation profit. So by answering that question, we'll make sure everyone heard the response. If you look at a set of financial statements and you see gross profit going up, cost of goods sold dropping, you may assume the company's buying or producing more efficiently. But what if management purposely held back on purchases, liquidated layers purposely, and raised their profit? So we've got to disclose the liquidation profit, especially if there's a significant decline.
So you only have a liquidation when you're eating into the prior year's.
Yeah, the base layers, yeah. I mean, you could consider any, as Tony was asking you, really, if you wanted to consider any lower cost than you could have had, it would have been a liquidation. But as you'll see, it is generally the base layer, or the base layers, because the beginning inventory could be made up of several different layers. So let me just go back to this, it's a good point. If you now go back here, and you look at this, and Tony had the same point before, if you look at the ending inventory now, the ending inventory of this year becomes the beginning inventory of next year. It's got different layers. So now next year, if you eat into this layer, it could be considered liquidation going into next period. All right, so now we will calculate and disclose the liquidation profit. And the liquidation profit is really nothing more than what you see here. It happens to be $150 also. And that's because the units were $1. But what we do is we take the actual cost of goods sold with the liquidation, which is $250, and this is not very complicated. All you would do is make an assumption that you bought enough units to cover your sales. So if you sold 200 units, you assume you purchased enough to sell all of them, and that would have been your cost of goods sold. So liquidation profit is going to be the difference between what cost of goods sold actually was, which is 400, versus, actually it was 250, excuse me, with the liquidation, and what it could have been without the liquidation. And what this represents is that you buy enough. We assume that. Assume that purchases are equal to sales. At the cost, and that would have been the 400. So that would be cost of goods sold without the liquidation. So in order to calculate liquidation profit, we then say, well, if I sold 200 units, let's assume I bought 200 units at the last price that was there before the sale. And what was the last price that existed before the sale? $2. And that's the liquidation profit. The difference between that 400 cost of goods sold and the 250 with the liquidation. So the liquidation profit's 150. And what I wanted to show you here, remember I assumed that all the sales were sold at $7. Notice that this is what you would be looking at. So if you look at the company with the liquidation, it's showing an 82% gross profit, but if they didn't liquidate, their gross profit percentage would have been 71%, would have been lower. So the liquidation profit is calculated as the difference between what we could have had we purchased enough to cover the sales. So all you need to do to calculate liquidation profit is the following. Go back to the base data and you say, all right, I only have 50 units at $2 in the May 1st purchase. Let's assume the May 1st purchase was going to be 200 units at $2. And then when I sell them on June 30th, I would sell 200 units at $2 and my cost of goods sold would have been 400. And that's the assumed cost of goods sold. You compare that to the actual cost of goods sold, and that becomes the liquidation profit. So liquidation profit is the difference between the actual cost of goods sold and the assumed cost of goods sold, or hypothetical cost of goods sold. That's the liquidation profit. Now again, keeping the numbers simple, sometimes they're misleading. It just happened to be $1 a unit. That's why it turned out to be the same as the units that were liquidated. Yep. The actual cost of goods sold was $250 because it liquidated.
What you have written on the top?
Oh,
give you like
yeah,
a-
it could be.
so,
Yeah, it could be the.
the actual.
Yeah, I can move that. Yeah, if you want. I'll give that. Sure. Okay. All right, so that's LIFO liquidation, liquidation profit. Questions on that? So again, you just have to remember that the hypothetical cost of goods sold that would have avoided the liquidation is when purchases are equal to sales. In this case, we sold them at 2, and the cost that would have been available to you at the time of sale is $2. Now this gets more complicated with multiple sales throughout the year, but we'll stay with one just to make sure you've got the concept. ConocoPhillips, oil and gas company, they use FIFO, LIFO, and average cost. They use everything, depending on the inventory level. Just looking at some of the things we've already done, they just want to show you the progress we're making as we go through. I mean, you look at, we looked at cash and cash equivalents. We've looked at notes receivable already with the allowance. We've already talked about related party receivables. Those are non-trade receivables, let's say for employees, right? So officers have loans and they have receivables from their employees. Here's the inventory we talked about right now. So their inventory is going to be 1,060,000, and these are lines, so it's 1,018. So this is the ending inventory. Now, to find out what's going on, we look first at management's discussion and analysis. So we went through the annual report components. That's from the annual report. So in the MDA, it says that we have several valuation methods for various types of inventories. Consistently use the following methods. Commodity-related inventories, those are oil and gas, would be on the LIFO basis. Then they tell you they measure these inventories at the lower of cost or market, which we're going to talk about in a couple of modules from now, in the aggregate. So they apply lower of cost or market to their total inventory. Just try to put that in the back of your mind, keep it there, because we're going to look at, you can apply lower of cost or market to aggregate inventory, you can apply it to product lines, or you can apply it to individual units of inventory as well. But we'll get back to that. Then it says that there are write-downs that will take place if the market value collapses for the inventory. Now, it tells you LIFO is used to better match, that is, directly associate the inventory cost with current revenue. So remember we talked about LIFO, the income statement objective, so it's very consistent with our discussion that the income statement objective of accounting for inventory is to properly measure gross profit by matching or directly associating the higher cost of goods sold under LIFO with the inflated sales dollars. And that's what they talk about right here. And they use the word matching, direct association. Then it says costs include both direct and indirect expenditures needed to bring the item to its existing condition and location. As we said, all reasonable and necessary expenditures. So again, just proving to you I'm not making this up. It's actually used in practice. And it includes both unusual but non-recurring or unusual items or research and development costs are not going to be included. So unusual, abnormal spoilage, remember we said that? Waste is not included in the inventory. Now it tells you that materials, supplies, and miscellaneous inventory, such as tubular goods and well equipment, are valued using various methods, using weighted average and the FIFO basis, and it's consistent with industry practice. So when you turn to the actual footnote itself, that was from MD&A, it tells you that the commodity-related items are on LIFO. So this is going to be the LIFO basis up here. And this is going to be average cost and FIFO. For the other inventories, materials and supplies. Then they go on to tell you that inventories valued at LIFO total 341 and 269 million, so it's in there somewhere, respectively. So they have to tell you, this is predominantly LIFO, I know the numbers are not exactly the same, but they have to tell you either the percentage or the dollars that are under LIFO. And it says the estimated excess replacement cost over the LIFO was 124 and 104 in 2017 and 2016, respectively. That is the LIFO reserve. This is the LIFO reserve, the excess of the current cost over the LIFO cost. So they're telling you the LIFO reserve in 2017 was 124. That's in 2017. And in 2016, the LIFO reserve is 104. So the difference, and by the way, that could be stated as the difference between FIFO and LIFO. It could be stated as the difference between replacement cost and LIFO. It could be stated as, current cost and LIFO. Sometimes they'll tell you what the inventory would have been under FIFO. So I can't tell you what the disclosure is going to look like. We're just talking about different terminology a little bit before we started class. So, you just can't say what's going to be there. But notice it said there was a liquidation, and it actually increased their net loss by $1 million. Now that's kind of opposite. So what might have happened is that prices could have been falling, and they liquidated old layers, which released higher costs and caused a greater loss. All right, so I want you to pick up on this last thing. First of all, everything we talked about is in this footnote. So you got the LIFO reserve, you've got the liquidation profit that's in there, and you also know what possibly you've got in terms of LIFO inventory. Notice it says that due to the liquidation, it increased the net loss, which means that instead of prices going up, prices could have been falling, and the layers you liquidated could have been higher prices. And that would have increased, that liquidation could have increased the net loss. Now, do we know if the company was trying to have a larger loss? Remember we talked about earnings management? And I've got another article that I want you, I'll post it on the ethics behind earnings management and the reasons why companies do it. But maybe since they had some net losses reported, so for example, go down, they've got net losses here for each year, so maybe they're gonna try to increase it. Might as well, if you've got old costs sitting there, you might as well release them now. Make the loss $1 million bigger. It's not going to do too much, is it? I mean, it's going to go from 854 to 855. If it increased the loss by $1 million, you might as well get rid of it now than next year. So maybe they allowed inventory to shrink. They held back on oil and gas production, right? And now they eat into those old layers, and they've got those units covered, and they're gone. And costs are now increasing net loss. So again, this has everything we need to convert. So let's do this. Let's just take this inventory, and let's just say, well, what would have happened if we? This is going to be a combination, as we know, of LIFO, average cost, and FIFO. And I want to remove the LIFO from this, and I just want to get average cost and FIFO. Now, average cost is not going to be affected. How can I convert that inventory? How can I convert the inventory? I got the LIFO reserve, right? So all I got to do is take the LIFO reserve, and just add that through. So I've got 1984 and 1,122,000. So now I've just converted. I've just taken the LIFO out of that company, if you like. I've just removed the LIFO method.
So if it was reversed, you subtract it?
If I had FIFO and I wanted to go to LIFO, yeah, I'd subtract it. Internally, that's what they're doing. I mean, internally, they've got the FIFO numbers that they now convert to LIFO for financial reporting. And the only reason why, as I said, they're reporting on the LIFO is why? Because they have to do it for tax purposes, right? They want to use LIFO for tax. And by the way, the reserve, in this case, the reserve went up by, is it 2420, right? Went up by 20? Yep. Am I right? Yep, went up by 20. Okay, so the reserve increased by 20 this year. Increased by 20. So that means I would have a lower cost of goods sold and a higher profit under FIFO and average cost. So you can convert these financials. So questions on using the footnote so far?
So adding the LIFO reserve, say that it's total and keeps us cash.
And FIFO, yeah. I can't strip out the average cost from this, so I know that by adding back the reserve, I'm increasing the FIFO number. So essentially, I'm just increasing the FIFO number, not changing the average cost by doing this. All right, one last point, and I'll take a look at another company, but again, everything we've covered is here. I mean, just having to find the right angle. Okay. Changing the LIFO reserve went up by 20. All right, so let's see how we can use that. If you go down to the financials, you'll see that this is not, by the way, this is interesting that we talked about how many companies use a single step versus a multi-step. This is a single step income statement. This is a publicly traded, large publicly traded company. That's a single step. So this means that analysts have to go through a little bit more trouble getting the gross profit. And by the way, where is the gross profit here? The gross profit's buried in this number, production and operation expenses. So if you read the footnotes, that's where it is. I think I also added it down on the bottom. But this is a single step statement. All the revenues together minus all of the expenses. Now, if you wanted to convert the company on a pre-tax basis, what you would do is, I guess you would go into the COGS is in here. This includes the LIFO COGS, and what you would do here is subtract that out. 5153, and that would be your FIFO and average. Doesn't do much with the profit, but it does lower the cost of goods sold, as you would expect. So right here, when you have an increase in the reserve, it's what you would expect. So the cost of goods sold here would be 5173. The cost of goods sold under FIFO would be 5153, means you got a higher profit. I mean, that's what the footnote does. So having LIFO, we're not done with it yet. There's more to go with LIFO. Just a continual set of issues for us. But that's how you would use the footnote. So again, this is a publicly traded company using a single-step income statement. And one more disclosure for you, then we're going to move on to Module 5. First, any questions here? All right. One more company, and that is Coca-Cola, and they use average cost and FIFO. All right, so here's their inventories. If you notice, it's in 2016, $2,675,000, and in 2015, $2,902,000. In their footnotes, and I'm showing you both, they're identical, and this, I'm doing this so that you could see that what's in NDA is pretty similar to what's in the footnote, except without all the details. So the first paragraph is from management's discussion and analysis, and it tells you that inventory consists of raw materials and packaging, including ingredients and supplies and finished goods, including concentrate syrups in our concentrate operations and finished beverages in our finished product operations. Inventories are valued again at the lower of cost of market. We'll see what that means. And it says we determine cost on the average cost or first in, first out methods. Then when you go to footnote number 4, which you're referred to, again, these are not on the same page. I'm cutting and pasting them from different parts of the annual for the 10K. You've got inventories consist primarily of raw materials and packaging, the same story, and then they tell you the inventories below. So the inventory is made up of raw materials, and there's probably not much work in process, I don't think. Can anyone think why? I mean, do you shut the machines off with kind of syrup halfway through? No. So there's really no work in process. So it's just really raw material, supplies, and finished goods. And that, notice that is going to do one thing for us. That's going to tie back to the balance sheet, right? It goes right back to the balance sheet itself. All right, and this is their income statement. It's fairly standard, and there's the cost of goods sold as it's given to us. All right, so that is it for the disclosures, and hopefully that pulls it together. So those are the inventory disclosures. We'll do a little bit more on inventory, but before we do that, questions on anything we've looked at so far. So far, you need to be able to calculate inventory predominantly on the perpetual basis. We need to think about LIFO reserves, how to use them, where they're disclosed, and the LIFO liquidation, and how to get that liquidation profit. Dollar value LIFO. Dollar value LIFO is, and we'll probably do some more examples in the back on this. Dollar value LIFO is a tax method that companies will also use for financial reporting purposes. The idea of dollar value LIFO is to minimize clerical time, because if you had to do LIFO for every product, let's say it's a retail store. Just think about walking into a retail store and looking at, or even Amazon, with a warehouse where they sell online. If you look at every shelf, every bin, there are hundreds of different products. If you had to calculate LIFO for each one of them, it would be very time consuming. So companies and accountants have decided to find ways to minimize clerical time. Now, we had something, we're not going to cover it here, unit or pooled LIFO. And what would happen, just to tell you what this is that you would take all of your purchases for 1 year and get an average cost. And then every year you'd have a layer as if you made one purchase at the average cost. So you would sell something at the average cost, but on a LIFO basis. So as soon as the sale took place, you would go to the later average from the period before. Now the problem with that is that average costs are heavily affected by the number of units purchased at each price, and that doesn't allow you for enough aggregation. In fact, that's why we have dollar value LIFO, because they could be similar. So typically, if you look at traditional LIFO, the items have to be identical. In fact, they have to be the same standard unit, or the SKU has to be the same. Unit LIFO would be substantially identical, but dollar value would allow you to group even more. So usually I hit this chapter right around the World Series, so a little bit off, my timing's off, or the game, series didn't go as long, but there weren't enough rainouts. But traditional LIFO, you'd have to take one type of baseball glove. Then unit LIFO would say, well, we could pool all equipment, all baseball equipment. And dollar value LIFO allows you to put the entire sporting good department into one unit. Now, how do you do that? You convert everything to common dollars. Dollars are dollars, right? I mean, I don't care if it's a baseball bat, a baseball glove, uniforms, whatever they are. We're not differentiating between units, we're differentiating between dollars. And this is where it becomes a little difficult to envision, and I'm going to give you an example, but the good thing about dollar value LIFO, dollars don't change. Dollars are constant, so that if you add new products, it's $1, it's not a different product. So if you add a new brand of baseball equipment, or a new type of baseball equipment that you never carried before, you throw that in, it's $1, right? It's dollars, you can just add them together. So if you convert all inventory to a common unit of measure, it allows you to aggregate them. And that's what we're doing with the dollar value LIFO. Now there are steps for those of you that like to use steps and memorize them in applying it. So we're going to go right to an example, because this is theoretically pretty simple. I mean, it's just a matter of getting a dollar amount or a price index, but technically it takes a lot of computation. So the first thing I'm going to do is you're going to have to convert. And everyone have economics here? At least macroeconomics, you dealt with consumer price levels. That's what we're doing here. So we're going to convert all of your inventory first to base year prices. Now what's the base year? Well, it's the year that you first adopt dollar value LIFO. That base year could change. You can use a consumer price level index. I could give you the index, or you have to calculate it, and that's known as the internal price index. Once you have all of the inventory at base year prices, the change in inventory at base year prices is a real quantity change. So let me just say that again. If you're holding prices constant and you subtract the beginning and ending balances at the same base year prices, that's a pure quantity change because you're holding prices constant. If it increases, it's called an increment. If it decreases, it's called a decrement. Once you have the increment or decrement, I'm going to have to show you this, but you price them out at the price index, you would add them to the LIFO layers, and then you would determine the LIFO reserve. And the LIFO reserve would be the difference between the FIFO inventory and the dollar value LIFO. And we'll find out that you'd have to make a journal entry for that adjustment. So you have your inventory at FIFO. You subtract that from the dollar value LIFO. That's the reserve you need. You'd subtract out the existing balance, and that would be the adjustment. This looks just like what? The balance sheet approach is for accounts receivable, correct? Balance sheet approach. So again, as I said, when we do coverage of certain topics, you get a lot of mileage out of it, because this is a balance sheet methodology that you're going to use here, you're going to use in receivables, you'll use in an allowance for tax purposes, as you'll see next semester, and there's plenty of other opportunities to use a balance sheet approach. So you take the difference between the LIFO and FIFO inventory, that's the reserve you need, you look at the existing balance, and then you determine the adjustment. If the reserve goes up, then you're getting what you want, right? So if the reserve goes up, that's why I left this here, if the reserve goes up, you're getting the case where the cost of goods sold has to be higher under LIFO. Reserve goes up, higher cost of goods sold under LIFO. You debit cost of goods sold, and you credit the inventory. That is used to reduce the FIFO inventory to LIFO. Remember, I had this on the board, so let me put this back on to remind you that you're going to have internally you'll have a FIFO inventory, and you'll have the reserve. So this will have a debit balance, the reserve will have a credit balance, and when you are going to have increasing reserve, it's going to have a higher cost of goods sold and a lower LIFO inventory. If the reserve is going down, then you're going to debit the reserve and credit the cost of goods sold. Because when the reserve goes down, you're going to have a lower cost of goods sold under LIFO. So those are the steps. Now, the best thing to do is to illustrate. And what I wanted to do, so I'm going to show you. Let me make this a little smaller. This is an example. This is not something you're going to do on an exam. It's way too complicated, but you need to see this first to understand the process. I've got a company, and actually this is one of my clients. The numbers here are not obviously the same as the client, but the client manufactured floor tiles. There's a factory where they use certain types of resins and other types of material to manufacture floor tiles that you see in corporations or in your school. Not here, we have other floor tiles. So these are the types of tiles they had. And this is the base year, which was 2019. And then when you look at 2020 and 2021 and 2022, you see that the prices are increasing. But these are the current costs. So if you look at the bottom line here, everything here is at current cost. So this is going to be current. This is your FIFO or replacement cost number. Now, the first step in dollar value LIFO is to convert 2020, 21, and 22, and that's the reporting year of 2022, the last one, to convert them to base year prices. So what are you going to need to do? You're going to need to take this entire column and replace it here, and that's what I've done. So you're now going to have everything on the base year. So let's just make sure we see that this is the base year prices. And that doesn't obviously change anything in 2019. But for all the other years now, I'm now going to have this at the base year. So in 2020, if I had everything at the base year, 2021, if everything was at base year prices, this is what it would look like. As I said, you're not going to have to do this on exams or too elaborate for homework, but it is going to show you the process. So what you would have to do is convert every year to the base year prices. So now what you've got is you have all of the inventory at base year prices. So the green would be the base year prices. And once I do that, I can get a price index. And a price index is the ratio of current to base year. So if I took the 72.5 and divided by the 65,050, I've got the index for the first year. By the way, the base year is always what? 1. So we know that. But if I take the 72.5 divided by the 60,050, I've got the index of 1.1145. All right, so I take the current cost divided by the base year, and I've got the index. For the second year, I do the same thing. I take the FIFO cost or the current cost of 52 divided by the 42.6 at the base year price. Now I've got an index at 1.2206. And then finally, in the last year, 59, is the current cost. The 450850 is your base year, and that's your price index. Now, I could give you the price index. Sometimes you have to calculate it. And when you calculate the price index, it's FIFO or current to base year. And sometimes you have to convert to base year. Now, the other important point is you have, if you look at the numbers in green, you've got all of your inventory now at base year prices. So let me try to make this as clear as possible. If all of the inventory, and remember, you got 5 or 6 different types of tiles there, right? So I took, and this could have been 100 different models, or 100 different types of floor tiles, or 100 different types of sporting goods, and I'm putting them into one pool. So now I've converted 6 items or 5 items into one. I've converted these, so it's as if you have one inventory item at one price. Now, this is the price of all of those items. That's it. You just have one price. But now, what's the quantity? Well, the quantity is going to be the increment or the decrement. You start with 39.5. That's your base quantity. In 2020, now remember, if everything's at base year prices, this is what I want to make as clear as possible. If you have everything at base year prices, the prices are constant, so that what you've got are really the quantity changes. So it's like saying that if you put this into some economic notation, which I used to show, but I don't know how reasonable it is, if you took, let's say, the quantity for year 1, that's the quantity, and the price at the base year, and you subtract that from the quantity of year 0 and the price of the base year. If you do everything at base year prices, if you factor out the constant, you're getting the quantity change. So if you just look at this in variables, that's what you're trying to accomplish. So if you wanted to take the inventory at base year versus quantities year 1 at base, quantities at year 0 at base. So this is going to be year 1 at base year prices. This is year 0 at base year. You could factor out the price and get the quantity change. So in the first year, if I had any inventory at base, 65,050 minus beginning, it increased by 25,550. Next year, any inventory at base is 42.5. Notice the beginning is what? The ending of the last year. So actually I have a decrement here. This went down by 22,450. And then finally, 45,850. Base year prices and the inventory minus the beginning of 42.6, I've got 32.50, an increment. So the way it works is on base year, I started with 39.5, I added 25,550 units. So let's just say that again. It's like saying that I started at the base year with 39.5 units, not dollars, just units. I've added 25,550. The next year, I delete or have a decrease of 22,450 in units, and then I've got 3250 increase in units. What's the unit price? The price index. So all you need to do is multiply the unit change by the index, and that would give you the value of the inventory. I'm going to show you that in just a minute. Now, before we get to that final example, just one last point is that sometimes you're given the index, depending on the problem. if you're given the index, the internal index here, my clients used to calculate the index internally. Today, you might find it more convenient to use what? A consumer price level index or an industry index of inflation, whatever it may be. If you've got the index, you divide it into the current cost, and that gives you base year. So if I give you the index, just divide it by the FIFO or the current cost, and you'll get the base year prices. All right, so what do we have so far? You've got inventory at current cost, you've got everything at base year, you've got the price index, and you've got the increment or decrement. Now I'm going to show you how to calculate the dollar value of LIFO. Let's go to 2020. So your base year was 39.5. I'm going to go through this as slowly as we need to. We don't need to finish this today. But starting off with a base layer of 39.5. This year, you had an increment. So if you took the ending inventory at base minus the beginning at base, you got an increment of 25.5. Now, why do I do that? You probably say, what a waste of time. You have that number here already. I need to know the change. And I'm just trying to be as systematic as possible. Why? Because this is made up of two layers, but you have to understand what LIFO. And I tried to mention this before. Now, Tony had a question, and we also had a discussion about these layers that are a critical issue in LIFO. I've got two layers here. I got a beginning layer at $1, and I've got an increment that cost me 1.1145. So here's the thing that I think is very difficult to really envision initially. That's your quantity. Those dollars are quantities. So forget about the dollar sign here. Those are units. And these are not a price index, but it's a unit price. So it's as if I started the year with 39,500 units that cost me $1. During the year, I've acquired 25,550 units that cost me 1.1145. That's the way you have to think. The dollars are units, the price index is the unit price. So now what I've got is base year plus the increment gives me dollar value LIFO. So this number is, you need to do that, I'm sorry. This number, 67,975, is dollar value LIFO. If I subtract out the FIFO or the current cost, that's the reserve I need. That's what you might call a target balance. That's my target balance. I look at the reserve, there's nothing in there, that's the adjustment. And I'm going to say a credit is the way I'm doing this. That's why I know that before when I had that on the board, the liquidation profit, I'm careful this time to show you that the brackets mean credit. I need a credit in there. So I've got to reduce inventory. So let me show you the entry. And I have to increase cost of goods sold by converting the FIFO to LIFO. I'm going to debit the cost of goods sold, credit the allowance to reduce inventory to LIFO. This is a LIFO reserve. Okay, so this is the LIFO reserve. And on the balance sheet, we're going to show the net amount. Now remember, internally, as I showed to these T accounts before, internally, I've got 72.5. But externally, I've got to show 67,975. I want to do one more year, and then I'll take some questions. Let's do one more, and then we'll take some. There's 1 year left. We can finish with that as well. Here's 2021. Look at the chart carefully. You've got layers. That's the key to LIFO. You got a base layer of 39.5 that was valued, those quantities were valued at $1. In 2020, you added $25,550, which is what? 25,550 units. Those units are valued at 1.1145. That is the price of those units. Now, we know that this is going to be, we calculated this already, that the ending inventory at base year is 42.6. The beginning inventory was 65.5 at base. There is a decrement here. Remember, we showed you inventory dropped by 22,450 if you go back to the prior schedules. The problem is, this is LIFO. Last in, first out. I'm not building the layer now, I'm decreasing the layer. It comes out in LIFO order. These units are coming out of what? The prior layer, and what's the cost in that layer? 1.1145. So this is LIFO. Because you're going to say, if I didn't make that last statement, you're going to say, how's this LIFO? I don't get it. Well, that's why the decrement case is important for you to see, because it is LIFO. Now, question for you. What if the decrement, question, this is part B of an exam question. What if the decrement in base year was 26,550? So let me just change this for a second. That's why I want to take your questions now, because this is where you're going to really see this as LIFO. What if this decrement was 26,550?
You have to take $1,000 from the base layer.
Yeah, what would happen is that this decrement would be split. You'd have 25,550 at 1.1145, and then you would have 1,000 at 1.
Like one said, you will have a liquidation.
Yeah, it goes to LIFO. It's the in LIFO order. So this is the way dollar value LIFO would work.
So what happened to the price index for 20?
Good question. All the units at that price were sold. So the other, you put the other index to 1.2.
Yeah, 1.2.
Yeah, the 1.2 is the current index for 2021. Doesn't show up in your inventory because all of those units were sold. You have none left.
What would be the year of that decrement?
Yep. Because the decrement means not only did you sell all of those units at 1.2, you've sold some at, let me just clean this up for you. You've sold them also at 1.1145.
So if you had an increment,
It would add it at 1.29. So good question. So if there was an increment this year, that increment would be coming in at 1.2955.
1.2. You mean 1.2?
Oh, I'm sorry. Oh, 1.22. Yeah. There was another two. Yeah, 1.22. So if there was an increment this year, 1.2206. Right. Now we do have an increment in 2022, so let's just do that. By the way, here, very important point is that if this is your dollar value LIFO now, 42,955 is dollar value LIFO. The current cost, FIFO is 52. That's the target balance. Target balance is 9,045.
Do I calculate my correct index?
Hold on a second, let me move this up so you can see it better. So this is dollar value LIFO. This is the FIFO. This is the target balance. This is what you have in there already, and that's the reserve you need. That's the adjustment. Now, question.
At the dollar value LIFO, do I calculate my price index at that point?
No, only if the
Just restate it.
only if the company decides to change the base year. So the adjustment you need is 4520, so it's exactly the same as what we did before. And the adjustment, debit cost of goods sold, and credit the allowance for the reserve. By the way, notice that the use of dollar value LIFO avoids liquidations, even though there was a quantity decrease, and that's why we use it also. It's superior to perpetual in that regard. And of course, on the balance sheet, you've got dollar value. All right, last case, let me just show you this, and I gotta get these exams out to you too, so once again, we're building layers. All right, so now you've got the base layer at $1 or 1. You've got the increment at 1.1145, a decrement of 1.1145. In this year, ending inventory at base, 45,850. The beginning inventory was 42,600. There's a small increment, but it's got to be at that new price. Okay, it's got to be at the new price. And then this is dollar value LIFO. FIFO, reserve needed. Balance is 9045. And same thing follows. The adjustment is going to be 3190.